My name is Michael Guyette, publisher of the Lead Lag Report. Joining me for the hour is Dr. Jeff Ross. I know a lot of you have seen on Spaces before. I'm going to make this a good one-on-one conversation between the two of us. But Dr. Ross, introduce yourself to the audience for those who aren't familiar with you. What's your background? How'd you get involved in markets? And do you insist that all of your clients refer to you as doctor?
First of all, no, that's only my stage name, right? So I just go by Jeff. So please call me Jeff. So quick background story, I'm 48. So back in college in the 90s, I had a love and a passion for both investing and medicine, and I had to decide which I wanted to do for a career. I decided on medicine back then, so I went down the pre-med path. Went to med school, residency, did something called interventional radiology, which is image-guided minimally invasive surgery and diagnostic radiology. Lots of training. Took another 6 years after med school to get through that. My head finally came above water for some air in 2008. With my family, we moved to Colorado Springs. And then by 2009, I decided that I remembered investing again and how much I enjoyed it. So I started a blog back when blogs were cool in 2009, teaching people how to invest on their own. I quickly got picked up by The Motley Fool and Seeking Alpha, for people who have heard of that, and used to write investment advisory type articles for those outfits. After a while, I had enough of an audience built up that people asked me if I could manage their money because they like my style. And I was always like, you know what? I'm just a doctor. I just do this kind of for fun on the side. But it put a little bead in my bonnet, right? A little thing in my brain. So I thought, man, what if I did start my own financial firm? So long story short, by 2013, I had laid the groundwork for Valuations capital management. And by 2014, started managing money professionally. So I have a hedge fund called Valuations Partners, which is just a long, short kind of macro fund, and then an RIA called Valuations Capital Management. A couple of years later, ended up getting my MBA in finance, and I've been doing kind of the dual career thing off and on since 2014 or so. So that's where we are today.
It's interesting hearing somebody go from not only switching from one domain to another, from the radiology medical side to the investing side. The radiology side, medical side, there's a lot more of a clear link between cause and effect, right? You do something, you're going to see the results. There's a clear line. In the world of investing, you don't have the same dynamic, right? Results, performance can be a function of luck as much as skill, sometimes more luck than skill, whereas you don't want, a doctor to be lucky. You want them to be skillful. How did you approach that dynamic of getting yourself mentally prepared for the industry of investing? Because it's not as obvious that the smarter you are, the better your returns will be.
Yeah, 100%, Michael. I agree with that. And so I think the common thread, because I've thought about this a lot myself, and what makes me kind of gravitate towards both and be, solid at doing both. I think it's having a systems approach, right? So a lot of the best investors that I see who have switched careers are former engineers that then switch into finance. So I think of like Lynn Alden, Preston Pish. There's a lot of these type of people that are kind of in my circle, at least, who they think in terms of a systematic approach. And so that's what I do as a physician, as a radiologist. Everything we do in radiology is systems based, right? It's you understand what normal is. You understand how a normal body works. You understand the different imaging findings of what is normal. And then you look at what do disease processes look like. And from a systematic approach, you take it in when the patient first walks in the door to when they get their imaging to we finally give them a diagnosis as a radiologist. It's all systematic. So I think of investing as exactly the same way. It's a systems-based approach. And I know you do this too. I follow your work too at Lead Lag. You could do some awesome work, but it's basically what can we use? What kind of clues from a systematic approach can we look at from a macro top-down perspective that can suggest where asset prices are going to flow? So, there's different things you can look at. You can look at what is inflation doing? Are we seeing inflation growth? Are we seeing disinflation or outright deflation? What is the economy doing? Is it growing? Is it shrinking? Is it kind of moving sideways? Those kind of factors. I throw on top of that liquidity, right? So is net liquidity in the United States, is it contracting? Is it expanding? And what's worldwide liquidity doing? when you factor in all of those things together, you can sort of, and I always say sort of because you can't do anything 100% in investing because it involves human emotions as well and psychology. But you can sort of predict or guess with higher probabilities the direction of different asset classes. As you know, I know again you're kind of a thought leader in this space. But so like what are tech stocks going to do if we know what those underlying fundamentals are doing? What are consumer staples going to do? What are bonds going to do? What is the dollar going to do? So that's how I approach it, and it tends to work pretty well over the long period. There can be seasons, months, quarters, even years where you can sort of get it wrong, where the assets don't move in the way that you would predict, and then you have to kind of scratch your head and figure out why. So all of that is super interesting to me. I'm constantly, as an investor and a fund manager, trying to figure out what I'm doing wrong, how could I improve my system, and how can we get better returns going forward.
The point about emotion and psychology is obviously critical when you're dealing with a doctor. When you are a doctor, you don't want to have to be emotional or be connected necessarily to the results. You have to be very matter of fact, right, in terms of a diagnosis. And that's why I think, similar to me, as you mentioned, you prefer a more systematic approach because you remove the emotional aspect of it. But the reality is, when you're managing other people's money, you can be unemotional, but they're not necessarily going to be. Same deal with a patient, right? But you're not having as much kind of close contact on that end. I think it's important to stress that systematic investing doesn't necessarily mean that your approach is always going to work, right? Everything has cycles, including whatever your systematic approach is designed to take advantage of. So talk about for the audience, what is the systematic approach that you follow for the hedge fund, for your SMAs? And talk a little bit about opportunity set, because I think what's often missed in the way that people think about a rules-based approach is not necessarily the signals, but how you're expressing the signal through what you're investing in.
Yeah, so good question. So that's where all of this gets interesting, right? Is how do you use your kind of personal preferences and skill set to hopefully have some kind of advantage over the general population and over the crowd, and that changes with time. And so I think from what I've learned, I started out as basically a value investor. Just a traditional value investor who focused on the healthcare space. But what I realized over time as Vailshire grew over the years is I actually love macro, and I love thinking about how the world works from a top-down perspective and from a macro perspective. So that tends to be my overarching sort of theme and what guides how I do investment decisions. A case in point for that is as we all know, especially looking back, it's easy to see, but the last decade was just zero interest rate policy, right? The Fed was supporting everything. There was a Fed put underlying everything. It was growth at all costs. And so if you weren't in the growth sector, that's what actually helped pull me out of just being a traditional hardcore value investor. It just doesn't work. It doesn't work when you have zero interest rates and PE multiples just continue to skyrocket. You get left completely behind unless you're into growth type investing. So that was sort of clue number one for me. And then number two, what I think about, I look ahead and I think, we are not going to have a duplicate of last decade, this decade. I think if anything, the overarching theme of the 2020s is going to be one of stagflation. So for people who don't know, just basically a stagnant economy, stagnant economic growth, and sort of persistently high and volatile inflation, at least relative to what we had last decade. And so, likewise, that's how I push our portfolios in that direction too. I think of what sorts of companies will do well. If we have a period of stagflation, which kind of companies can still make significant profits, even if we have kind of a weak economy and deal with inflation. And so that's how I put our portfolio. So I think so. And then case in point, I'll give some actual specific examples. When we were in the 40-year bond bull market, treasuries were the place to be, at least for a good chunk of your portfolio. It was basically a portion that you couldn't lose within your portfolio, and it added some stability, decreased volatility in general. I would say going forward that unless you're talking about shorter term trades, that bonds are basically dead money. And I think they're going to be dead money for a very long time, like decades and decades, probably for the rest of my lifetime. So if I think that, there's no way I'm going to put my clients into bonds if I think that they're basically dead money. It just doesn't make sense. We've switched for Vailshire, instead of the traditional 60-40 stock bond portfolio, we think of it as a 60-40 stock and sound money portfolio. So instead of bonds, and bonds would have been in that allocation in the past, now I think more in terms of Bitcoin and gold and cash. So depending on, when I have clients who are fairly conservative, we have a higher gold and cash allocation and a relatively small Bitcoin allocation. For the more aggressive clients, we have higher percentages of Bitcoin because I think it's just a better form of money, though obviously it's much more volatile. But that's kind of how I think about portfolio allocation from a top-down view.
So there's a few different directions I think we go with that. So to your point about zero interest rate policy, clearly that favored growth, and that's when FANG became a thing. Small caps started underperforming large caps in 2014. Emerging markets went nowhere, and emerging markets are essentially a value tilt on the international side of things. But it's odd, right? Because you have much higher rates now, and growth has been the play, right, with these kind of mega cap tech names. So does a year like this make you maybe question the link between zero interest rates and growth dominance? Because you don't have zero interest rates, and again, this has been a growth market.
Yeah, so a couple thoughts on that. So what do I think drives growth is not just, so we have had higher inflation, but we have had really impressive disinflation, as everybody knows, right? It peaked at 9.1% back in the summer of 2022 and has steadily fallen. In general, you can see longer-term correlations, as you know. When you see periods of disinflation, that correlates with higher multiples, and vice versa. When inflation is rising, multiples tend to decline. So I think part of the reason why we've seen such an impressive outperformance of growth stocks and tech stocks, things like that, is because we've had that significant disinflation so far this year. I do think we're nearing the end of that, by the way. And then number two, liquidity. So liquidity bottomed. Basically, you can look both U.S. net liquidity and worldwide liquidity bottomed kind of the end of September, sometime in October, and then rose sharply up until February. And then even there's another kind of little bit lower high in April of this year. It has since, though, been decreasing. So that to me explains why we had this boost in risk assets and in Bitcoin as well, where they just significantly outperformed. However, I will say, and this could be a good part for discussion, where are we now? Since kind of the end of April, liquidity has been decreasing substantially, both in the U.S. and then trending sort of sideways to lower in the U.S. as well. Yet these tech stocks have just continued to outperform. That to me is the strongest divergence out there. It makes me more nervous than sort of any other factors that I look at. And to me, those jaws have to close at some point. So when I see that large divergence between risk assets and what liquidity is doing, it definitely makes me pause. So I think that unless something changes, unless risk assets know something that I don't, and liquidity suddenly shoots higher again, to me it looks more likely that risk assets are going to head lower at least for the coming months.
Yeah. Okay. So this is a good broader discussion. I've made the case back in first week of January that this is probably going to be a melt-up year because it's a pre-election year. That's undeniable, strongest in the cycle. But that there's still a credit event out there. And for a credit event to occur, you need to have liquidity coming out. So that seems to be consistent, at least from my vantage point, with how to think about things. The challenge here is that FOMO is a very hard thing to stop, right? It's like, I almost think you need to have an event, something exogenous to break it. It's not going to just kind of turn around on its own, because you can see it in the way that people are allocating to equities, allocating into the AI names, in terms of the overconfidence, which I know it's hard to quantify, but I certainly see it on FinTwit. Talk about what you're doing with that viewpoint when it comes to the hedge fund and the SMAs. So if you've got a long short portfolio, I'm going to make the assumption that you're maybe gradually lowering your net long position or maybe degrossing. But when you have a view like that, what are you doing to?
Yeah, so good question. So I'm actually doing less trading currently this year than I have in years past. I'm like right now, we're 100% long in our portfolios, other than just small cash positions for some of our RAs. But in my hedge fund in particular, we're actually 100% allocated long, even though, like, just to your point, to what we were just talking about earlier, even though I think that these tech stocks continue to be overbought, and this divergence with liquidity, I think, is real and something to be concerned about. It's something that I don't want to fight right now. Just like you, I said the same thing. This is where we are in the election cycle. what liquidity is doing as well. And then even coming into the spring and heading into the summer, I said, I think this is going to be a surprisingly good summer. I think we might get a little bit of GDP growth in Q3, which would be taken positively. And if we continue to get disinflation, that's actually kind of a nice combo for risk assets. I will say, though, that if this continues on, if we continue to have an extension of this rally, kind of AI-led rally, tech stock rally through the summer, I will start putting hedges on at that point. And again, unless something changes substantially with liquidity, I just think the way I look at from a cyclical standpoint and economic standpoint, the fall is looking kind of rough to me. I think we may hit rough patches again. I think this credit crunch hasn't even really started to rear its ugly head yet, even though it's definitely credit itself is definitely tightening. I'm waiting to, I'm watching closely the high yield OAS spreads. I'm watching unemployment. When those two things start to trigger and move to the upside, that's when I'm going to start getting nervous and start hedging as well. So there's a long answer to say, as of now, we're basically long only, but I anticipate by probably August or maybe September that we're going to start putting hedges back in place and just kind of let this rally run for another month or two.
I started doing this in February when I started kind of just saying, the next month kind of ominously. I would say March. And the argument I said in February for March was that it would be a highly volatile month. And then the regional bank dynamic hits, market didn't go down, but it was volatile. Then I said April. I said third week of April might be the start of correction. You didn't have that, obviously, the headline averages, but 7 sectors out of 10 went down in May. And I've been repeatedly now saying October. Now, when I say October, I'm not saying October 87 type of crash, but because I myself believe that we're still in a bear market, which sounds crazy, but I've outlined the reasons why in terms of the interaction of treasuries to equities. It seems plausible that, markets do what they do, which is they surprise everybody, which means you could retest the October level, at least in my view, to maybe break the bear market. Again, could be totally wrong on that. And I've referenced the 87 example a few times, right? Because in 87, you had a market as strong as we are seeing this year, was a pre-election year, closed the year positive, but you had still a crash after the Dow was up 38% in October 87. And then you had a Fed pivot. Not that you have to have the exact kind of parallel, but it sounded to me like you don't think it's impossible to see maybe a similar sequence where very strong part of the year, and then to your point about it being rough in the latter part, that's where you could have some kind of major tail events. What do you do when that happens, if that happens? Meaning, do you start saying, you know what, this could mark a prolonged period of decline, the macro environment's getting worse because now equities are actually driving the economic cycle? Or, do you look at that tactically and say, this is the best time to start allocating? And I'll preface that by saying, going back to your point about bonds, I'm with you. Bonds are not the place to be because no matter what, they've got to keep on inflating away that debt. Tactically, you have a dislocation. That's going to be great for anybody that wants to capture really high yields. I mean, you could have a situation where junk debt blows out substantially, and that will be a hell of a buy to capture 15, 20, 25% type yields.
Yeah, I completely agree. I think at some point bonds are going to make a fantastic trade, right? And there's a couple things. So once we head into a recession, traditionally bonds are the place to be. You can be on the long end of the curve. You can also, if you time it right, if you're on the short end of the curve, that's a great place to be. Once the market believes that the Fed is done hiking and they're going to rapidly start lowering the Fed funds rate, you can catch that as a fantastic short-term trade. So I agree with you there. Other things, obviously, it's simple to just raise cash. Increase your cash allocation. Other things that tend to do well, gold tends to be a safe haven asset, although there are times where it can also get pulled down hard like it did back in March of 2020. That I know you were around then for that too, but so bonds and gold both got hammered, even though they were supposed to be quote unquote safe haven assets. Even when you have periods of liquidity tightness, they can get pulled down pretty hard as well. So I don't know that we'll have that. I kind of feel like, to me, it feels like we're sort of in the early 2008 vibes right now. Where the markets were sort of wondering, like, man, did they actually do it? Maybe we are going to pull off a soft landing, or maybe there's, it's not going to be a landing at all, and we're just going to sort of soar through this. Maybe the Fed actually did figure this out correctly, but I think it's sort of a fooler, and that at some point the effects of, again, this credit tightness and still this massively inverted yield curve, it hasn't even steepened yet, right? It hasn't even re-inverted what should I say, re-uninverted back to normal, and so we still have this the real significant potential for a recessionary bear market. It could be significant. It could be really bad, a la 2008, 2009. But it just still remains to be seen. So like you, again, I tend to be optimistic for now. But as these indicators start to roll over, if they do, that's when we'll put on these type of hedges. One other thing, because you asked what do we do? So besides kind of gold, higher cash positions, we also have, I like to use inverse funds. They're just super easy to use, and I'll throw those in client portfolios. So say NASDAQ continues to rip for another month or two, and then it looks like things are rolling over, we might put some short NASDAQ kind of inverse funds in our client accounts as well. And those tend to do pretty well.
Yeah, I mean, you got to be real, as you know, you got to be real careful on the timing of that, right? Because you can be right directionally, but if the volatility of the sequence is nasty, you can still grind down, even though the directional bet is right. I always go back to, in 2008, there was a juncture where both the FAS, which is the 3 times long financials ETF, and FAZ, 3 times short financials ETF, 1 long, 1 short, both triple levered. There was a point where they were both down like 70% for the year because it was so volatile, and the daily reset path kind of kills you on that. I noticed you have laser eyes on your Twitter profile, and I give actually a lot of credit to those that even throughout the drawdown in Bitcoin maintain that, because a lot of people obviously got rid of the profile pictures at the top as the drawdown was taking place. You and I both know March 2020 was not exactly a good period for Bitcoin as a quote unquote safe haven asset. Now, I happen to think that if you do have a credit event, perhaps this time around, Bitcoin does diverge. So I know a lot of people make arguments that Bitcoin and the NASDAQ are correlated, which factually they have been, but you could have a divergence this time around because correlations do change, right? And gold was a better defensive play, during those drawdowns. I want to get your take on what's going on with Bitcoin currently. I know there's a lot of excitement around Bitcoin ETFs. Do you find this ETF talk to be ultimately positive for Bitcoin? And the reason I'm framing it that way is when the futures came out, Bitcoin topped. When the ETF came out on the futures, Bitcoin topped. Is this time going to be different?
Yeah, so lots of great talking points in here. So first of all, why do I have my laser eyes? Back in 2021, a group of us decided we were going to keep our laser, put laser arrays on our profiles until Bitcoin hit the price of $100,000. What I look at it, I'm true to my word, so I'm keeping mine on, even though it sort of excludes me from discussions with people because it's hard for them to take me seriously in kind of traditional macro rooms.
First of all, in fairness, I have lumbering gold eyes and look absolutely fucking ridiculous on Twitter. So I think you're good on that.
That's right. We all do what we got to do, right? And so I'll keep them on until it hits 100K. To me, 100K signifies that it has reached a stage of adoption and acceptance, both in the U.S. and around the world. That at that point, it won't really need me to be, so fanatical about it. But that's why I have my laser eyes on. They'll be here until it hits 100K. Whenever that happens, I think it'll probably be 2025, maybe late 2024. So how do I feel about it? I agree with you as far as we may see a divergence in the price performance of Bitcoin. Why? Because a lot of what the main issues are this time around, because of what the Fed policy did with their raising rates so quickly, as we all know, that devastated regional banks, right? These banks that had all of these long-dated treasuries in their portfolio, they suddenly were underwater, at least relatively speaking. And so when clients started to get nervous, and started to take their deposits out of banks, they suddenly had that duration mismatch. That can still happen, right? I mean, we're still seeing the bank term funding program that the Fed put out. That's the last I looked anyways, it was over $100 billion. So that's being used heavily. That means regional banks are in a lot of trouble since that's kind of their policy of last resort to stay afloat. Why does that matter? Because the whole premise of Bitcoin is to be your own bank. It's to sort of get out of the traditional banking system. And when people see traditional banks fall and they want to pull their deposits out of these banks, where do they put them? A lot of them put them in Bitcoin. And so Bitcoin actually performed pretty well, even though the markets were tumbling back in I think it was March-ish of this year. I would expect that to happen again. So I actually think we're going to have round 2 of the regional bank crisis happen sometime this fall. And we're going to have problems again. Again, kind of similar to what happened in 2007, 2008. We had a couple early companies that went down, and then we had this relatively quiet period, and then basically everything hit the fan in the fall of 2008. So I think it's setting up to have kind of a similar experience this time around. And if that were to happen, then yeah, sure, Bitcoin actually could end up being a safe haven asset again. I also throw in some trading, like TA kind of stuff when I make my decisions. So I look at overbought, oversold levels, things like RSI and MACD. I like to look at daily charts for the most part. So how Bitcoin will respond, I think, will depend upon how it has performed up until that time. If we get into the fall and maybe Bitcoin has underperformed in the near term and liquidity continues to kind of languish both in the US and around the world, I would expect a divergence, and I would expect Bitcoin to actually outperform for a time, and it would surprise a lot of people who just simply consider it to be a risk asset that's correlated to stocks. And again, NASDAQ, if it continues to outperform leading up into the fall, I would expect for it to take a serious breather and tumble and get hit pretty hard. If we had another wave of this banking crisis where people started to panic and the Fed started to talk about maybe stopping QT and maybe even restarting QE again, I think in the near term that would actually be a net negative for most risk assets, but could be a positive for Bitcoin and gold as well.
So it's interesting because I would actually argue that small caps are maybe suggesting that. So the narrative now is breadth is improving, right? Because of the number of stocks that are hitting 52-week highs is increasing. But I keep going back to breadth like that as a definition. Doesn't matter if riskier, smaller cap stocks, which are very connected to the regional banks and the dynamics for credit flow, if they're not outperforming large caps. And if you look at the small to large ratio, you've had a little bit of a pickup the last couple of weeks, but it's still minimal, right, in terms of that strength. So you have this interesting dynamic where small, higher beta is keeping up largely with large, in the last month and a half in terms of performance. It looks like it's strong, but in reality, you're not getting this sort of cap boost from the domestic excitement side. And that may be because there's still kind of lingering concerns around regional banks. And also, I'd argue just, refinancing risk into higher rates, which again, for a lot of zombie companies becomes problematic. If you're going to, at some point, introduce more hedging, more shorting to lower your net long. And to be clear, I'm against directional bets, outright shorting personally, because it's very hard to time it directly. That's why I prefer risk-off assets like treasuries, dollar, utilities, gold as sort of your ways of playing volatility. But if the time comes when you say to yourself, you know what, I need to start increasing my short book on the long short side, where would you focus your attention? I mean, you mentioned tech, but that it may be more than just tech that gets hit.
Yeah, good question. Again, it kind of depends. I like to look across lots of different asset classes, as I know you do as well. It would depend heading into it what has really outperformed, and things that I think look kind of obnoxiously overbought. Those are the ones that I think are going to correct the most. So obviously tech is an easy one, right? Like NVIDIA is just massively, wildly, crazily overbought right now. It just doesn't make any sense. Even if you really believe in AI and where it's going, these valuations are just absolutely absurd and obscene. So those kind of stocks, I think, are sort of the easy ones for what would get hit hard and what would get hit quickly. Other ones, I'm not as convicted about other areas. You brought up small cap stocks. I think small caps are kind of catching a bit of a bid right now, mostly because of what's happening with. We're seeing a little bit of economic growth right now and still this disinflation. And that combo tends to actually be a good environment for small cap stocks. So I would expect that to continue to rally maybe for another month or two. But when things hit the fan again, and if we do head into, this disinflation, even deflationary conditions mixed with slowing economic growth again, I think small caps are going to get hit as well. So I think that would be another target. You can, like I said, inverse funds are easy, and especially for these just kind of larger categories, inverse fund of NASDAQ, inverse fund of small cap stocks would be a great hedging mechanism. Those are probably the two that come to mind, top of mind. Normally, I would say because of Bitcoin's volatility, like you can do things like hedge. Like I like to short Coinbase and short like the Ethereum, the Grayscale Ethereum Trust, those kind of things. If I feel like crypto will get hit hard, because crypto obviously is just basically beta on Bitcoin. I don't like shorting Bitcoin itself. But to your point and to what we were talking about, Bitcoin may actually surprisingly outperform if we head into this. If regional banks start collapsing again, if we see another deposit flight out of these regional banks, I would expect a surge in Bitcoin performance. So I would be pretty reluctant to short it.
All I heard during the last few minutes was that Nvidia's fucked. That's all I heard on my end. And by the way, just to be clear, like, obviously I've been having a lot of fun with it. And obviously I've been wrong because I said it before the earnings and it's, had a stupid move higher. But yeah, it's like time frame is everything with this. Graham and Dodd has nothing to do with gamma squeezes, right? So anybody that's making money, God bless, you can make a lot of money in manias by keeping going back to, can you keep it? And even like these narratives around stop losses just don't make sense, because if stop losses were the answer to keeping money in bubbles, which I think we're probably in, at least in terms of that part of the marketplace, everybody would be rich, and that's just not how it works in practice. But it is a remarkable phenomenon when you see these mega cap names trading like shitcoins.
Yeah, I mean, it's incredible, right? It sort of defies logic, and it just doesn't make sense, especially for people who have been versed in value investing in general. You brought up Graham and Dodd. I just think, this is not the environment we're in. To me, everything changed substantially and materially back during the Great Financial Crisis. I think that's the period where, I like to say this, I say it sort of tongue-in-cheek, but I actually believe it. That central banks wrested control of the stock market from the underlying economy almost completely back in 2008, 9, and beyond. Once the central banks got heavily involved in this whole liquidity dynamic became important, I think it basically took over, and so the underlying fundamentals don't seem to matter nearly as much as what the central banks are doing. To me, that's really disturbing. I like to think of myself as a free market economist and investor, but I just don't think free markets really exist. I do think, getting back to my laser eyes, that I think Bitcoin is probably the closest to a free market that the world has right now. But as far as bonds, stocks, even things like private equity, I think are based on the flows of liquidity in general. And so, unfortunately, I hate to even admit it, but we have to pay attention to what Powell is doing and what the other central bankers are doing around the world. We also have to pay attention to kind of fiscal policies. How much money is the government pumping into the private sector? That tends to be net positive for assets as well. So coming full circle, this Nvidia and these tech stocks that have reached these insane valuations, this can kind of go on as long as that these central banks continue to do this just absurd levels of pumping, right? Where I see we both saw Warren Buffett kind of scratching his head a decade or two ago, wondering like, how can the PE possibly get so high? How can valuations get so high relative to GDP? Well, I just say it's because these central banks have wrested control, and this liquidity function is what is so important. When we see liquidity expanding, multiples expand, and that's just how it is. So if you're concerned about valuations and you continue to be so, I think you're going to continue to be wrong for the most part, as you're proven. And I'm not saying you, Michael, but you in general.
No, I haven't proven wrong. Listen, the thing is, like, it's not. I'm not suggesting anybody short. I'm very loud in saying I don't believe in shorting, right? But it's like, anybody that thinks that this is going to be not go the way of Cisco, I think is very, very wrong. I think the Cisco analogy is the right one right now. But the other part is that it's more than just liquidity; it's also market structure, right? It's far easier to see these types of moves when you have availability of doing zero DT option trading and ease of leverage, right? To cause the tail wagging the dog, so to speak, in terms of the derivatives actually driving the underlying.
Right. Yeah, that's been an amazing phenomenon to watch this come out and see these massive institutional bets on these zero DTE options. They're really wild, and so you have to learn to play that. And as individual investors, we can't compete with what these guys are doing. Right. That's a game that we probably will lose at if we try to play. Those are these gambles that we have no influence on the direction of the market versus these guys who are putting these massive amounts of liquidity into the system. They can move the market, so we can't. So as individual investors, though, that increased volatility, we have to learn to use that to our advantage. When we see great assets and we see these just massive spikes in prices, either higher or lower, I think it behooves us to do what we can do to take advantage of that. We want to use these spikes lower to buy great assets and maybe to consider on these spikes higher to consider maybe taking profits or to at least, rebalance our portfolios a little more often than we normally would. I say all the time that I think the number one job of the Fed is to manage expectations. And I think that's what they do. And to your point, they're not always doing stuff that seems relevant, but they're always talking, right? They're always talking about something. And the Fed officials are, in between their big FOMC meetings, they're out in public and they're clearly trying to steer the narrative. Right now, their narrative, they continue to try to be hawkish. Even though it's so interesting because they talk about QT significantly, but then what's interesting is when you actually look at the components of net liquidity, there's sort of this underlying stealth QE going on that's at least maintaining liquidity and causing it to go sideways. Regarding why I'm still long, actually, it's not because of liquidity. In fact, maybe you missed it earlier in the show, but liquidity actually both in the U.S. and worldwide is actually declining right now. It's been contracting since late April. And we're seeing a huge divergence right now, especially between tech stocks, which continue to grind higher, and small cap stocks have joined in the rally, and liquidity, which is declining. So that to me is very concerning, but it can continue to go on for longer than actually reasonableness suggests. Why do I think it's going on? I think because, and I discussed this back kind of in March, April, that I expected the summer months to actually be surprisingly good. Why? Because I think that the economy is actually hanging in there. We're seeing some economic growth in the third quarter, and we're continuing to see disinflation. And when you have that combination of economic growth and disinflation, that's actually really good for tech stocks, and it's even better for small cap stocks. So to me, that explains that. Now, looking a little bit further ahead, heading into the fall and winter, I expect to see economic growth to actually slow down again. And then on top of that, if we get disinflation or even outright deflation, that would be very negative for risk assets in general. So I'm bullish for now. But I do plan on, and we talked about this with Michael earlier, I do plan on probably putting on hedges. Consider shorting some stocks heading into the fall, raising cash positions, maybe increasing gold positions, things like that. Obviously, everybody has their own reasons for why they're long or short and how they participate in the markets and which assets they are participating in. But yes, I would say we're starting to get to the point where the optimism, I think, is getting a little bit obnoxious. And the people who think that we're basically going to have no landing and we're going to kind of sail through this, those people are starting to win, right? You're seeing these people all over Bloomberg and CNBC because they've been right. So people assume that they're going to continue being right. And when I see kind of that narrative shift where basically everyone has embraced optimism, that's when I start to personally get kind of nervous, right? That's when I start to want to put on hedges like, okay, this has gone a little too far. We've been focusing on all the positives in the economy, right? The services sector is still hanging in there. Unemployment still has yet to spike. The OAS spreads have not blown out yet for high yield bonds. That's been good so far, and the optimists have been right. But again, it feels so much to me. And you look young, Dylan. I don't know if you were around, but 2007, 2008. This is almost exactly what happened in 2008 too. In the middle of the year, people were talking like, you know what? I don't think we're going to have a recession. I think the Fed policy worked. And, they have our backs. And so, things are looking pretty good. But when you look underneath the hood, right? I mean, bank credit is just drying up rapidly right now. People's savings are drying up. There was a ton of money in the system. The lower half of the Americans in terms of income, they are just getting destroyed right now, right? So inflation is still high for them. Prices aren't going to decrease. They're just, they're to these higher levels and they're just decreasing a little less quickly now. Increasing a little less quickly. Life really sucks for them. They're working 2 jobs. They're barely making it right now. Student loans, as we know, the payments for those are starting back up again in September. That's going to be just another hit to the kind of the lower economic echelons. We have this K-shaped kind of recovery still going on right now. And so when I look at all these different things and kind of the fact that these interest rate hikes haven't even really hit the economy yet because they have a delayed effect, I still think there's going to be, a bill to pay and it's going to be substantial. Could we have a soft landing? Possibly. But we could also have a hard landing. And I hear fewer and fewer people discussing that as a possibility because of the success of these risk assets this summer. to me, it could be a fooler. And so coming full circle, we've, this is not unexpected that we were going to have a kind of a good summer. I think conditions are probably more likely to change heading into the fall and even in the early parts of 2024, where things may turn ugly again. So I'm not on the optimistic boat just yet. And then one final thing, that's getting back to the Fed and their rhetoric. Their rhetoric has continued to be very hawkish, right? They're continuing to say that they're going to remain higher for longer with their rates. At some point, the markets will force them to lower rates, and they're going to be forced to start QE again. That's when the floor drops out of risk assets, if it happens. But then when that floor dropout moment happens, and now we have the Fed behind us with QE, like real QE, not stealth QE like we're seeing right now, that's when I think you want to start thinking about going all in and getting seriously long risk assets. So hopefully that all makes sense.
I would add real quick, it's funny, like everyone now is like saying, oh, all the people who are calling for recession, they're wrong, they're living in the past. Okay, all that is just a reminder that nobody can tell the future. So in saying that, whenever you counter somebody else's prior predictions, you're inherently making a prediction yourself that the recession isn't coming. But if they were wrong and that crowd was wrong before, why can't the crowd now that say there's no recession also be wrong 9 months later? It drives me crazy to think about how people don't understand that oftentimes the things that they criticize, they fall prey to, right, in their own thinking about markets in general, right? Which is why I go back to it's about conditions, not calls, and you've got to kind of be flexible based on the way things are playing out.
If you've been following me, you probably know that I look at Bitcoin and the rest of crypto as two completely different assets, right? So I look at Bitcoin as basically it's better money for a better world, right? And I view crypto as kind of a combination between, cryptographically secure tokens and kind of fiat, right? So they take kind of parts of what are good about Bitcoin and parts of fiat that are good or not. Yeah, that's debatable. And they combine the two. So regarding sound money, I would not put crypto in that. I would put crypto as a highly speculative play. I do think that lots of the gains that we saw in crypto in past cycles were because of this massive two things, because of the substantial liquidity that was backing the markets kind of in general, and because they were basically venture capital plays in an unregulated scenario. So I think that regulation has finally come to the space. Even if it generally, like, even if we have examples of where cryptos don't get regulated as heavily as how heavy Gensler wants to do it, right? It was kind of a slap in his face, these recent announcements with Ripple. I don't think that means it's just a wide open path for crypto going forward, though, because I still think the way I view most crypto is they're just unregulated and unregistered software companies, right? They just all they are is code and software, right? And so at some point when they do get regulated in some form, I do think that will make people investors to have to start to consider, like, do I want to invest in this software company or in this crypto, which is also a software company? This is kind of a long run answer, but basically, I view Bitcoin as the soundest of money out there. I thought treasuries did make a reasonable investment allocation for the last 40 years or so. I don't think that's going to continue going forward, but I don't consider the rest of the crypto space to be kind of in the same category as Bitcoin, as gold, and as even dollars.
I wonder for your SME clients, right? So separate from the hedge fund. Because obviously if you have an SMA separately managed account, that client can see the holdings and account. And I don't know, maybe not all of your clients follow you on Twitter to see the laser eyes, but are you allocating to Bitcoin ETFs for those clients? And if so, is there pushback, right? Because I think outside of the Twitterverse and cryptoverse, the average kind of mom and pop investor may not really understand why to put a position there.
Yeah, great question, Michael. So back in 2018, in 2019, our allocation to Bitcoin was actually zero. But then I started basically so when I kind of went down the rabbit hole, as they call it, and started to study it kind of in depth, I started teaching my clients about it. And then to start out, I had about maybe 5% of Vailshire clients were up for putting some Bitcoin, just a little, like 1% to 2% allocation. in their portfolios. What that did was awesome because I had then two kind of similar sets, right? I had some clients that had the Vailshire portfolio plus Bitcoin, and then the rest of them was just the Vailshire portfolio without Bitcoin. And then after a couple of years, I had these two comparable data sets where I could show my clients. I'm like, hey, look, I know you're concerned about its volatility. I know you think it's, it's terrible money that's used by criminals and destroys the environment and all this nonsense FUD that you hear from the New York Times. But look at the difference in portfolio performance, with Bitcoin or without Bitcoin, even a small allocation. So fast forward as clients started to see the difference, and it really was a pretty impressive difference in performance, as you can imagine, heading into 2021. By 2021, the majority of my clients got on board. And then by 2022, all of my clients now are in at least some Bitcoin. Now, what kind of Bitcoin? I say Bitcoin, but we're actually in Bitcoin proxies. So the main one we use is MicroStrategy, which I think is actually better than any ETF will be as far as Bitcoin ownership. And then also we have Bitcoin miners. So Bitcoin miners, as you know, it's like Bitcoin with beta. It drastically outperforms in bull markets and drastically underperforms during bear markets. But during these bull market phases, we have both of those allocations in our SMA accounts. When will an ETF get approved, a spot ETF? I don't know, right? That's the true answer. If I had to guess, I don't think that it is just coincidence that BlackRock came out like at the exact same time the SEC sued Coinbase. I think that the SEC and Gensler are coming in to basically clean house and to clean up the exchanges, and as a result, that may pave the path and pave the way for these ETFs to get approved. I would be surprised if it happened this year. I was saying I think it's probably going to happen early 2024. But again, I wouldn't even be surprised if it didn't happen. I could totally see Gensler just coming out and throwing cold water on everybody and just being like, nope, we still don't trust it. We still don't, Coinbase has too many issues to work through. Still too much fraud and speculation in the community. So anyways, Michael, you asked at the very beginning, and I don't think I answered this. Are spot ETFs good for Bitcoin? I would say that on the positive side, they're good for price, right? I think, there's $72 trillion of boomer money that is basically not even in Bitcoin at all right now. I think a lot of that the floodgates will basically open and a lot of that will go into these spot Bitcoin ETFs. And that will definitely be a net positive for price if that's what you're into. I'd say the negative side is Bitcoin wasn't really designed to be captured by Wall Street. It has its benefits outside of Wall Street, right? It's the fact that you can hold your Bitcoin in cold storage. You can move it permissionlessly to where you want to move it. It actually appreciates in purchasing power over time versus depreciates like fiat currency does. When you buy the spot ETFs, yes, you participate in the price action, but you're kind of losing all of the other benefits of Bitcoin. So I tell people like, hey, that's cool. And that will bring in a lot of money and it will increase the price. But, when you truly get to understand what Bitcoin is, you want to own it personally. You want to hold it in cold storage and be your own bank and not rely on the traditional banking system.
For those, Jeff, who want to track more of your work, aside from Twitter, where would you point them to?
Yeah, so I just have a website, vailshire.com, VAILSHIRE.com. And like we talked about, I'm a fund manager and I have an RIA. I do separately managed accounts. If you're interested in that, you can actually just shoot me an email. Personally, it's info@vailshire.com. And I'll get back to you personally.
Good place to wrap this Twitter space up. Everybody, please follow Dr. Ross. Follow me too, given that I've got a couple more spaces coming up. And be not afraid, NVIDIA is still fucked. So thank you, everybody, for joining. Thank you, Jeff. And we'll hopefully see you all later. Cheers, everybody.
Thanks, Michael.